Welcome to SuperGrowth MultiBaggers. This is a brief introduction to our work, who it's for, the analytical principles that underlie it, what makes it different. So I would say that while the research we do is for anyone interested in investing in rapidly growing companies, probably the people who will relate to it most are people who've actually run businesses, people who know how to read financial statements, who know the difference between an income statement and a balance sheet, who know about the interplay of margins, asset turnover, know what it might mean when a company's receivables are growing a lot faster than its sales, or its inventory growing a lot faster than its sales, who know how difficult it is to grow a company without adding debt to cover increased inventory need, plant and equipment, hire and train people who take a while before they can make a meaningful contribution. So this is as much about businesses as it is about the stock market, although another primary principle underlying the research is that there are kind of two meandering paths that have a definite relationship to each other, particularly over the long term, but in the short term get way out of sync. On the one hand, you have the health of the business, how much money it makes, how fast it's growing, its balance sheet strength and balance sheet strength trends. On the other hand, you have what the market is currently fascinated with, which varies a great deal month to month. 1 month it's bank stocks because interest rates are going up. Another month it's semiconductors because there's a shortage. Another month it's COVID because, COVID. So when it seems like COVID's getting under control, they sell the COVID and they buy the, whatever, the oil stocks or whatever it is that captures their imagination. So this is for people wanting to capitalize upon that discrepancy between fact and conjecture, between fact and opinion, and benefit over the longer term in the highest quality, low debt companies traded in America. So basically, we're interested in the very few companies with consistently increasing free cash flow, consistently improving balance sheet, companies that have a degree of stability and consistency about them, companies that do something truly unique. I think that for an investor, it's of primary importance that you focus on an area that you're comfortable with almost on a visceral level. So for me personally, I like to think about, to read about, to connect with executives doing something truly unique and making a unique contribution to the market. Companies with intellectual capital, companies whose primary advantage is not their asset, but their people, the ingenuity and creativity of their people. It's also probably true that to run one of these companies, you need to have a certain degree of grit and persistence and an ability to ignore the market because, the market is swaying to and fro, and it's important not to react to that, to keep your eye on the prize and focus on the objective, which is continually enhancing what you do that's unique, that provides something important to your customer. A major advantage of these companies is that, they're a little, over time, they are impervious to the general market. That is, they have an internal rate of growth that's so superior to the average company, an internal momentum that defies the overall market and exists to some extent independent of the overall market. Most investors, I think, focus on predicting earnings or a story, AMD's semiconductors are better than Intel's, so we're going to invest in AMD, or whatever. A story about where the economy's going, where the market's going, what is going to capture the imagination of other investors next. We don't care about any of that. We're experts in businesses, in financial statement trend analysis, and we've developed software designed to take advantage of and benefit from emotion, which generally means we're buying on weakness, selling on strength, particularly weakness that develops momentum. So when a stock, on an average day might go up or down 2 or 3%, we're buying when that stock's down 5%, or when it's down 15% over the last week. So we're looking for the exceptional companies. Generally, out of 3,000 public companies, there are 10 to 20 that qualify. As I record this, there are 10. And so we're looking for the 10 most profitable, rapidly growing, low debt companies, and we're waiting. And sometimes we have to wait a long time, and we wait until the market is disillusioned, and either with the overall economy or with some news event, and people are cramming through the exits, and we're like giving them an opportunity to liquidate, and we're buying. Exactly how we do this, we every month run detailed financial statement trend analysis on every public company. That takes our software about 36 hours to do. It runs thousands of ratios on every company, looking at every aspect, from margins and asset turnover to, for instance, free cash flow versus total liabilities, cash versus total liabilities, the trends, interest coverage by free cash flow, capital expenditures. It tears apart every aspect of a company's financial situation, looking for emerging trends, looking for indicators of quality, of financial strength. One of the crucial issues that will often make it, or will often cause a company to fall out of our top 10 or top 20, is the stock price that goes up. We are looking carefully at intrinsic value versus, or estimated intrinsic value, because it's never a hard number, but intrinsic value versus stock price. And basically it's uses a variety of criteria, including earnings and dividends, but primarily it is free cash flow that we use to estimate intrinsic value. So while the market may say a company like Tesla, for instance, has tremendous value, even though it generates no free cash flow, it won't work in our model. So we're looking for rapidly growing free cash flow and a price to that free cash flow that's reasonable in relation to what's been achieved over the last 10 years. And admittedly, this eliminates a lot of good companies, but it's a conservative approach. It's a caution. It's designed to preserve capital. And so if a company, for instance, is trading at a price that indicates it has the potential to grow 30 or 40 or 50% per year, or generate that kind of return per year over the next 5 years, and the price goes up sufficiently to make it fall to even 29%, we at least temporarily remove it from our list of SuperGrowth MultiBaggers. Margin expansion accounts for roughly 50% of total long-term appreciation potential. So if a stock runs up a lot, it obviously has less room to run in the future. Right. Taking a look at the actual research, every day we run this report on the 50 fastest growing low debt companies in America, and we use this to identify the few that will qualify as SuperGrowth MultiBaggers, and at the margin they change a couple of them will drop out every month, and a couple of new ones might be introduced depending on the general market trends. The lower the market goes, the more companies that qualify, and of course, the higher it goes, the opposite's true because there's less upside potential. Um, so, for instance, right now, Zoom happens to be the company with the strongest financial statement trends of any public company or any super growth multi-bagger. You see that here in the explosion in free cash flow, improving financial strength, and improving intrinsic value, although the company is still trading at a premium to our estimate of intrinsic value, which in this case is probably pretty flimsy because there isn't a lot of history to go on. For the intrinsic value estimate to have meaning, it needs roughly 10 years of data to work with. And of course, Zoom hasn't been public 10 years. So Quidel, the next one, again, an explosion. This one also related to COVID, and in this company's case, COVID diagnostic tests. Futu, sometimes described as China's equivalent of Robinhood, brokerage and investment management firm. Alpha Protech, I won't go through them all, just make one quick point, and that is that what I look for more than anything else when I'm scanning through these companies is an improving financial strength trend. I found after years of working with these charts and graphs that that is the single most important indicator of future stock price performance. It's uncanny how well that works. Of course, that's financial strength is closely dependent on free cash flow, so they're all related. Intrinsic value, again, very dependent on free cash flow, but yeah, the one I primarily focus on is if I'm quickly scanning through these summary reports is the financial strength trend. For any subscriber interested in learning more about a specific, you just click on the company name and it takes you to the 11-page detailed report. The conclusions are all expressed in as few words as we can come up with. 5-year free cash flow and return on assets trend. Growth. Revenue, gross profit, operating free cash flow, pre-tax free cash flow. We use pre-tax for everything. Well, we use operating as a return on assets measure against assets, and pre-tax rather than after tax because of the modifications in the tax law over the last few years. We want to compare apples to apples. Dividends analysis, dividend coverage, dividend security, generally not applicable to many of these companies. Long-term free cash flow trends, return on assets trends, intrinsic value estimate. Table of financial results. Conclusions down the right side, improving or deteriorating. Return on assets analysis. Company has both improved asset turnover and improved margins, a rare combination. That's due to their disposable PPE and other medical garb during COVID. Capital expenditure trend, debt trend, no debt. This is an indicator of quality of earnings. High quality earnings require minimal debt to support and minimal capital expenditures. In this case, we have no debt, but we do have capital expenditures, so that results, instead of an exceptional or excellent, a good rating. Profitability analysis, return on assets, 3-year average return on assets, latest 4-quarter return on assets change, financial strength trend, and then we end up back at the summary report, which is included in this detailed report as well for easy reference. Next, we'll take a quick look at the artificial intelligence pattern recognition software we developed to determine buy at and sell at prices. And basically what this software is doing is looking at patterns over the last year based on hourly high-low prices, looking for patterns that repeat and result in particularly profitable buy and sell transactions. So the software runs all day long when the market's open and posts the results every few minutes, roughly 5 minutes, to the portfolio summary that all subscribers have access to. So you'll see here, I'm running this in the evening just for the purposes of creating this video, but every 5 minutes or so during the day, all these prices are updated. And for instance, here it'll say how far the current stock price is from the indicated buy at level, and down here, positions held for sale, the indicated sell at level. So the closest one right now, Qualis, 4.1% above. What that Python software you saw running a moment ago is doing is it's looking at the difference between the stock price now and the simple moving average. And it's identifying patterns that repeat that have resulted in advantageous positions, and it's executing buys and sells according to those patterns that it detects that recur over the last year. So for instance, and this is a very, very rough red line here, it's using numbers that are much more precise. This is what the actual printout of the results of the algo running looks like. And, you know, there's literally thousands and thousands of calculations in here that, you know, determine these prices. But it's, you know, simplified as just buying on weakness, selling on strength, high quality companies. Here shows in this company, BJ Wholesale, the times when it bought over the last year, and as you can see, it's not foolproof. It bought here, and the stock continued to go lower, and this is not a particularly. I mean, these trades, with the exception of this one back here in late 2019, these trades actually look pretty good. But for instance, if we look at QDEL, you'll see it's been buying in here, and the stocks continue to go down, and that's the nature here. You can see again, it bought, kept buying as the stock went down, and it was a month or more before these trades were profitable. So that's something to keep in mind. It's looking for very sharp drops like you see here that may indicate emotion, or there's obviously a large group of investors or speculators out there that sell what's weak and buy what's strong, and they see a downward movement gaining momentum, and they just sell into it, and it drives the stock to a unreasonably low level, and this algorithm tries to take, it's assuming that the financial statement trends of the company are strong, and the company's strong, and that the price action is unreasonable or emotional or whatever. So next, let's take a quick look at Netflix to describe in slightly more detail how the pricing algorithm works. This is a weekly chart going back through from 2010 to current, and what I wanted to show you here is Netflix was actually the best performing larger cap or medium to large cap stock in the 2010 to 2020 period. So it was up 3,746% in that time, 37 times. And yet, despite that, and my main point is that despite that exceptional performance, the stock actually had 5 price declines of 35% or more. And 2 were more than 40%. 1 was more than 80% in that 10-year, in that period. The average of the 5 declines was 47%. So the significance of that is you have the most exceptional performer of the 10-year period, and yet it was subject to a number of drawdowns or significant declines. And this algorithm is designed to identify those and capitalize on those. The way I have it set up right now, it looks for declines that have repeated over the last 12 months. So it's not, in something like Netflix, it may buy over the 10-year period, it may buy, I'm going to pick a number and very approximate, it might buy 100 times. So it'll attempt to identify the 100 weakest or times when the stock has dropped most significantly below its moving average, as can be seen here. Okay, well, I think that's enough for now, and thank you for your interest in learning more about SuperGrowth MultiBaggers and our research. We've put 10 years of hard work into developing this software and analytical approach. There's a lot more to it, but that's a good overview. In particular, we haven't talked much about how we report to subscribers. For instance, subscribers can sign up and receive a automatically generated email whenever a stock hits a buy at or sell at level. If you have any questions, please email me. It's easy to find my email on the Risk Research or SuperGrowth Multibagger website. You can also call. I'm happy to receive phone calls from subscribers and potential subscribers. You can subscribe on our website. If you're wondering what that snoring is in the background, that's Fozzie Bear, my 13-year-old golden / Bernese mountain dog. She would not be happy if I put her in the next room while I recorded these. So it's music. It's music in the background. And thank you again.